It is 9 a.m. here in Hong Kong, in Beijing, and in Shanghai. 10 a.m. If you're watching us out of Tokyo, good morning and hope you're all well. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning, the euro currency and bonds falling as far-right parties are winning big in European Parliament elections. Macron calls for snap elections in France.
Asia trades cautiously with Hong Kong and mainland China closed for a holiday. You have decisions, of course, this week from the Fed and also the BOJ are set to dominate trading, of course, the next few days.
And Apple's Worldwide Developers Conference set to start today with some big announcements on its AI strategy. All right, it is relatively quiet. We talk about these markets like Hong Kong, China, Taiwan, Australia, all closed for holidays here today. So you're seeing pretty much volumes are quite light here, but we're watching very closely what goes on when it comes to not just these euro assets. We talk about the setbacks that we saw, not just in France, but also Germany. That certainly is why we're watching the likes of stock 50 futures were lower here this morning. Bund futures are pretty much flat here. But certainly you're seeing that weakness in the currency here today and really kind of adding more vigor to this dollar trade after that strong jobs report that we saw on Friday, right? I think we were 4 standard deviations higher than estimates in terms of the amount of job gains that we saw. So that certainly rolled the Treasury market. We're seeing yields ticking higher, of course, about 15 basis points for your 2-year yield. We settled a bit around 488 here this morning, but we're still talking about a U.S. 10-year that's around 444. So certainly there's a lot of concerns here as market pricing now shifting to that first rate cut back to December now. Maybe we're back to just one cut this year. And we move away from jobs now to that inflation print in the U.S. later on this week. So in terms of the event risk, it's plenty, right? We talk about the Fed, we talk about the BOJ. Keep in mind, BOJ, that yen is back to around those intervention levels at 156, 157 this morning. We're also watching very closely what goes on with the dollar, right? We saw one of the biggest moves since mid-January after that jobs report. This is what your euro pairs are doing here right now. So you're seeing continued weakness across the board when it comes to the euro here in the Asia session. So we talk about, France, and really Macron going the extreme sort of move on announcing these snap elections now. And then you also have the worst ever result for the Social Democrats for Germany and Olaf Scholz. So certainly both of those were a bit of a shock for the market here today. You watch how that goes for euro dollar. We're at 107 levels, 169 for euro yen right now. And we talk about those shut markets. Certainly there's a lot of questions of what happens. It's Dragon Boat Festival here in Hong Kong as well as in China and Taiwan. Futures are looking like this here right now. We'll see how these all play out. But certainly we talk about this is a week of major, I guess you could say, landmines. Dave, China right now, watching your offshore rate, we're at 726 levels right now.
Yeah, which wouldn't bode well because we have lost some decent momentum in recent weeks here as it pertains to this Chinese equity market. So maybe the slower you move, maybe the less the damage, of course, if we do head into some of these headwinds, as Yvonne is pointing out. As Yvonne was also reminding everyone as well, so there is just a lack of volume liquidity at this point in time. You have major markets across the region. One should be up and running at this point. 2, of course, should be coming online this hour. So mainland China, Hong Kong, and Taiwan are shut. And Australia is also shut for a holiday. So in terms of volumes, equity market volumes were about 25% lighter than usual, which compared to what we are used to seeing for this time of the session. Now, Yvonne also talked about the jobs numbers coming through. On the 2-year yield, we're still about 15 basis points higher than the moment before that report came out, and a couple of standard deviations above forecast. A couple of things, right? You have the dot plot coming out this week. What will that change? What will that show as far as the changing in the Fed expectations there? Bloomberg Economics thinks it's still going to telegraph 2 cuts for the year.
But move from 3 to 2, right? Yeah. That's going to be a key gauge here. And I think Anna Wang and her team are saying this is probably one of the most pivotal Fed meetings we're going to see this month as well, to really give us a little bit more clarity on what the rate cut timetable is going to look like here. But it's interesting, right? When they talked about the nuances in this labor market report. Basically, you have an upsurge in job gains, but then again, that unemployment rate also went up to 4%. So they're thinking there's actually under the hood maybe what's closer to reality is what you're seeing with that 4% unemployment rate right now.
Yeah, the false number and what's going on really, and they think it's a better representation of the underlying weakness in the economy, which is the unemployment rate at 4%, which I guess takes us into how far behind you think the Fed might be as far as the rate cutting conversation is concerned. I think right after the jobs numbers came out, and we were talking about Citi last week, which was past then, still holding on to July. I think they've now ditched that.
And JP Morgan.
And JP Morgan, they pushed it back towards September as well.
Surrendering, really, finally, after that print. You take a look at when it comes to, of course, we talked about the Treasury market, certainly. You're still seeing not that much movement, but really 488. Are we getting closer to 5% for that U.S. two-year yield? That's a key question here now. And, of course, what's been going on in Europe and really the volatility there. Far-right parties have made significant gains in European parliamentary elections and dealing blows to the governments in France and Germany. Now, French President Emmanuel Macron's calling for a snap legislative ballot in a bid to stop the rise of rival Marine Le Pen. Bloomberg's Stephen Carroll has more from Brussels.
Far-right parties were expected to do well in these European elections, but their performance delivered a number of bombshells. In France, Emmanuel Macron has called snap legislative elections for the end of this month after his party came a distant second behind the far-right party of Marine Le Pen. In Germany, Chancellor Olaf Scholz's party had their worst score ever in a European Parliament election, facing off at the far-right AfD. There was better news for other European leaders. Italy's Giorgia Meloni's party performed well, increasing their score and confirming her control of power in that country. More broadly, the centrist alliance of parties that brought Ursula von der Leyen to the European Commission presidency 5 years ago did return with a majority capable of re-electing her to that position. She says she'll be reaching out to her partners in the coming days to build that alliance. The European leaders who will put her forward as a candidacy for president of the European Commission will meet to discuss that in a week from now. In Brussels, Stephen Carroll, Bloomberg News.
And let's bring in Mark Cranfield out of our MLive team in Singapore for us this morning. Mark, good morning, and thanks for joining us. Well, dark and early, pretty much. The tone coming out of markets post the results out of Europe, negative, if you could put it that way. I mean, bond futures weaker, the currency's down against virtually all of its peers, and the equity futures are trading down. And I'm wondering whether or not this is simply a knee-jerk reaction, or this is something you think that permeates throughout the course of the session.
It's all about Macron calling this early parliamentary vote. Traders are responding to something unexpected. The performance of the far right wouldn't have been a huge shock to investors. It just so happens I've just been in Europe for the past 2 weeks, and if you were on the ground there, you would have sensed pretty much that those kind of parties were going to do very well. There's a lot of discontent with politicians in Europe, so investors would have been bracing anyway for results to go that way. What they were not prepared for was for French President Macron to call this early election, and that is what the response is today. It throws in a whole level of uncertainty which nobody was ready for, especially for the bond market. So something that traders haven't had to consider for a very long time is this spread between the French and Germany 10-year yields. It's something which in the past has been a big disruption for European assets. It's been extremely quiet, understandably, because markets have been pretty well controlled and everyone's been looking at the Fed. Suddenly, for the next couple of weeks, in addition to all those things you said earlier in the program about the Fed, the Bank of Japan, US CPI report, now people suddenly have to worry about the French-German spread blowing up, because if that starts to widen quickly, and the early signs are from the futures market it's not going to be a good day for European bonds, then suddenly all European risk assets are up in the air and people will have to respond in a very defensive posture. That is not what they were expecting on Monday morning.
And Mark, you flag in particular this trough on oat futures of 123.66. Why is that level important?
Well, again, because people have had a slightly complacent attitude towards the French bond market. It is the second most important market in Europe after all. And they've been thinking, oh, everything's trading nicely, nothing too much to worry about. And then suddenly, wham, President Macron does this, and bond traders are very much on the defensive. So you would have had a lot of people who would have been sitting on positions, probably thinking, oh, nothing too much to worry about. Now, suddenly, they have to think, well, if it breaks through those kind of levels, momentum players could come in, leverage players could come in. It all could turn very ugly very quickly.
Yeah, and Mark, maybe tell us, how interesting is this week going to be? I mean, the fact that we talk about all these macro risks out there, whether it's the Fed, You have two inflation reports coming out of the U.S. You have the BOJ this week as well. What's going to be the most top of mind for you?
All of the above. But I think if there's a bit of a wild card, it could come from the Bank of Japan. I mean, everyone's talking about the Bank of Japan increasing rates slightly in July. But why not do it now? Why not get ahead of it? The yen really needs it. The Japanese yen is severely weak. The results from their recent intervention really are not very effective at all. So the whole Japanese authorities, they must be thinking to themselves, really it's time that the Bank of Japan stepped up and became a bit more aggressive. So why not? People are expecting them to reduce bond purchases, but why not do their small interest rate hike now rather than wait until July? If they really want to give the yen a push, it would be better for them to surprise the market and actually increase interest rates this week. When you surprise, positively or negative, you will get a market reaction. So the thing for the Bank of Japan to do would be to raise this week.
All right, Mark, we'll see if we get any of those fireworks. Mark Cranfield, our MLS strategist, joining us out of Singapore to kick off the week for us. Still ahead, Shikhara Investment Management says the Chinese economy has bottomed with better days ahead in the coming quarters. The CIO, Rahul Chadha, explains shortly. They also just launching a new fund as well. Stay with us. You're watching The China Show.
This is a really strong report.
Stronger than what people were expecting going in.
This jobs report is not recessionary. It is soft landing.
It does close the door on a July rate cut.
I think the Fed would still like to get a cut or two done.
There's no way they can cut or signal a cut in July with this data.
I still think September you target as doing that.
The reason we think the Fed is going to be able to cut in September and December is because we think that inflation is going to proceed with moderation.
At least as it pertains to equities, I think the Fed pushing out when they're cutting is good news.
There are no spare tires in this economy. So if you get it wrong, and you weaken too quickly, it's going to be a very difficult mistake to correct.
Our Bloomberg TV guest reacting to that strong U.S. jobs report. And let's bring in our next guest, Rahul Chadha, their founder and CIO at Shikhara Investment Management. He joins us now. Rahul, first of all, we'll talk about the funds that you just launched, or you're about to launch pretty soon, and congratulations on that as well. But just given what we've seen with this strong jobs report, the market continues to, I guess, doubt the fact that we're going to see rate cuts this year. I mean, overall, how are you looking at overall risk sentiment across this market now?
Yeah. So if you look at US markets, it's been a mixed bag. Again, Q1 data was soft. Q1 GDP was about 1.3%. If you look at last couple of quarters, data has been revised downwards. See, this job report was a fairly strong report. But if you see for last 6 to 9 months, bulk of the jobs been healthcare, government, some of the reopening trades, etc. So our sense is somewhere these high rates are going to work their way through the economy in terms of slowing down the economy. And look at the high consumer debt, look at the auto delinquencies, all those things that are high. What's doing well for US is this corporate spending, which is some of this is tech-related spending. Some of this is this IRA-related domestic manufacturing boost.
Okay, so what does this tell you about the preferences of this, the broader investor base as it pertains to the equity market? You mentioned tech, for one, has held up quite well. Do we assume that rates come down, and how does that affect, if at all, affect this long tech trade?
Definitely. I think our sense is there would be at least one rate cut for the year, because if you look at the real rates in US, the real rates are still too high. I mean, inflation should be around 2.5%, so real rates are around 2.5% to 3%. So at those levels, they should slow down the economy. And our sense is, look, July is definitely ruled out, but somewhere in Q4 you should see a rate cut happening. From a tech valuation perspective or a multiple derating, I think it's more of a bigger narrative of what's happening in AI. And this new AI arms race, which is going on, where each and every corporate wants to be on top of this so that they stay relevant for the next decade.
Yeah, it's interesting, right? We had the strong jobs report. We certainly saw the reaction in bonds, but stocks really kind of shrugged it off, right? And I think a lot has to do with this whole AI trade that you mentioned. If that's not going to be enough, what could actually shake off this bullish momentum in equities now?
So I think what could shake this off is this realization that Fed may be behind the curve, that you have economic data which gets revised downwards, and Fed is unable to cut rates. See, right now there is this implicit faith in markets that there's a Fed put. Fed is going to come sooner than later, or may rather move quickly. Should there be a need to cut rates, but should markets get this realization that Fed is constrained in its ability to cut rates, I think that's where we can see some sell-off.
Now, Rahul, you're launching as Yvonne is pointing out, you're launching your funds in two strategies. Correct me if I'm wrong, it's two, right? Mid-July. One is broader EM and one is in India, which I guess we can talk about given the shake-up post-elections in markets. But just talk to us about, you're in New York. I think you were recently in Hong Kong. I think I caught a glimpse of you at one of the conferences here. How would you describe appetite for EM equities at this point in time, given where we are in China and given where the U.S. market is?
Yeah. So, David, if I may correct, one strategy is an Asia strategy and the other is an India strategy.
Okay.
Clearly, we believe that things are kind of improving and improving for the Asian region. First and foremost is China. Like you were also there at the one of these conferences which were there. The sense one is getting from ground is that, look, the policymakers are seized of the situation, which is very different from what it was 2 years back. They want to restore the animal spirits in the economy. They want to get the business confidence back. And if you look at the numbers which are coming through, look, the revenue growth is a struggle, but clearly there is a strong focus on profitability. The competition has eased between the incumbent players and the new kind of upstarts because the VC funding is not there. So you can see decent set of numbers. And as property market stabilizes, as kind of these corporates start rehiring, down trading, which is visible in the Chinese consumption, should also ease. And that's how markets are going to bottom. So it's going to be a long drawn out recovery. Outside that, why we like Asia and why we're pushing out Asia to our prospective investors is that there's a strong story in Korea. So Korea benefits like Taiwan from this AI spends. We believe that there's a strong cycle coming in the PC and the smartphone upgrade as these AI features are included. The Koreans are totally enamored by what's happened in Japan because of this value up. And though it may take its own sweet time, but they're keen to follow. So if you add these markets and then what's happened to India in terms of stability of a government, I think there's a decent story for Asia going into 2025.
I mean, you mentioned India. I mean, I'm just wondering, is it still the same sort of dynamics after this post-election setback for Modi? Does it change his agenda or his mandate in any way for you to actually shift your exposure?
So I would say, some of the market participants kind of were a bit too exuberant. And to be fair, that happened because of these exit polls, because of what happened in last 6 months as Modi's party won the state elections. But look, in a democracy coming back for the third kind of term, there's always an anti-incumbency factor. The middle and the lower middle class have got badly impacted because of inflation, which was a squeeze on their incomes. So that was something which was there. So I think what they achieved, I won't be too disappointed with that. This is a decent number, 240 for BJP alone, and their allies, they're back in government. And think of economies, big economies like India, like an oil tanker. It takes a while to change the direction. I think the momentum in the economy is very strong. If you look at the business confidence, that's very high. You see kind of a capacity build-outs being started. Government's keen to roll out this infrastructure. The PLI schemes to attract in manufacturing are benefiting. So I think this would give a good pullback. And some bit of a noise, uncertainty is good. Else we were just seeing this market going completely ballistic. So I think some bit of a mixed emotions would give long-term investors like us an opportunity to increase exposure to the market.
And, Rahul, I assume, I'm sure that you've already looked at the prospects, which is why you're launching the India fund. But is it not daunting for, to try and compete with a market that like India, for example, a simple index ETF would do a well enough job for most investors out. And I'm wondering how you're thinking about outperforming the benchmark at this point in time.
I think that's a great question you said, David. And the reason we started Shikhara was our belief in the fact that active management still has kind of a room to grow when everybody around the mainstream asset managers are going the ETF way. If you look at the funds we've been managing in the past at my previous shop, annual outperformance for an India fund was close to 5% for the last decade. And I think India has that opportunity. And why we say that is, look, with the nominal GDP growing at 12, 13%, in 4 to 5 years, you're almost increasing the GDP by 50%. There are new consumer cohorts being developed. There are new industry segments being developed. A lot of multi-baggers are going to come. So India is where US was in the 70s, 80s, and we saw the amount of kind of a wealth being generated. So clearly for a bottom-up investor who's got a good regional perspective being in Hong Kong, boots on the ground in Mumbai, and a good global perspective in New York, I strongly believe that we can generate alpha.
Rahul, all the best on the new endeavor. Rahul Chadha, their CIO at Shikhara Investment Management, joining us there out of New York. Right, just ahead, we should be previewing the trading day ahead, but of course a couple of markets are shut here in the region, so I guess we'll get you more news in a moment here. Plenty more ahead, though. You're watching The China Show. Happy Monday morning. All right, weakness across some of your futures. A reminder that mainland China, Taiwan, Hong Kong, and Australia, cash markets are shut. And also, in case you're curious, the Celtics are up 3 points against the Mavs at halftime. More on all of that in a moment. It's a quiet day, so allow us some liberty here to check on more relevant news at this point.
Well, you should still watch us, right?
Yeah.
We're still here.
Yeah, we'll give you an update anyway.
Some analyst actions to tell you about NEO shares. Those are the 8 shares rated a new buy of Founder Securities. MTR also cut to underperform at Jefferies. They have a latest call when it comes to some of these Hong Kong property developers as well. May2, this is obviously that crypto proxy we look at here in Hong Kong as well, rated a new buy at Huaqiang with a price target about 430 here.
Right. Now, across these markets, equity markets are mostly weaker with the exception of the Japanese currency, 0.4% on the Nikkei. To the upside, the rest are either trading sideways, if not lower. The dollar strength continues into the region right now, and it might have to do with the fact that you are getting weakness, though, across the euro against all of its peers. More on those in a moment. Happy Monday. This is Bloomberg.
Welcome back. You're watching The China Show. Yeah, it doesn't feel much like really a Monday here if you take a look at what's going on. So Hong Kong, China, Taiwan closed for Dragon Boat holiday, but also Australian markets are closed. So some of these major markets are shut here this morning. Futures are pretty much slightly lower, but really Asia is pretty slow going here right now. Obviously, though, this week, though, is going to be jam-packed, Dave.
Yeah, on risk. So you have a couple of central bankers. Okay, a couple. I'm underscoring the importance there. So you have the Fed coming out, then you have the BOJ. A few hours before the Fed, of course, you have the inflation print out of the U.S. We should also mention inflation out of China is also due out this week. So sort of your key landmarks there. We'll get to some of the things to watch and the big things to watch as far as tech is concerned, so Apple and, of course, AI. More on that in a moment. The story we're talking about, though, early this Monday is what we're seeing over in Europe. And as you can see, Stocks 50 futures, 0.4% to the downside. You're getting some weakness already coming through in Bund futures and also Oat futures, bottom of your screens. And, Mark Cranfield, flip the boards, please. He was pointing out from our MLive team that traders are reacting not so much to this move right as far as the political spectrum is concerned, but the elections coming through being called out of France. Right, so weakness across the euro complex, if you will. So this is just against your big G10 peers. You spread this across your entire EM FX complex. You are getting a lot of weakness coming through in the euro. Again, to note as well, you have major markets shut, so there is a illiquidity issue as well, perhaps exacerbating some of these moves. In fact, just to get this in as well, the biggest move we're seeing, in fact, at this point in time on these key crosses is you're against the Mexican peso, right? The Mexican peso was sold off quite substantially last week. So you're getting a reversal of that sort. In fact, we have a great story, just to plug this as well, on the Bloomberg talking about how the elections has really changed to calm on the Mexican peso, which was really the favored currency as far as the carry goes. 10-day vols at the highest level since the pandemic hit on dollar Mexico. So how does that actually change and sort of mess with the math there? Just to give you a sense of sort of Friday into this morning, weakness coming through, a little bit off lows, if you could call it that. But yeah, quite a substantial move there as well. Back to the EMFX complex. And by the way, since you look at a 2-day move, a lot of that move also had to do with the fact that you have a stronger dollar post-U.S. jobs. So incrementally, because of the elections and political risk there, and the premium getting baked back in, Yvonne, we're getting weakness across the currency space. I guess more on this in a moment.
Yep, we'll definitely see that. So you mentioned about the macro risk really this week and the landmines that we have to kind of go through here. There's also one big one when it comes to the micro side of things, which is Apple, right? Set to lay out its vision for AI at its annual Worldwide Developers Conference later on today. Let's bring in Debbie Wu. She leads our North Asia tech coverage and joins us now from Taipei. And Debbie, it's interesting. We've heard obviously some AI features before, but not really a full-on AI strategy from Apple itself. What's expected today?
Well, what we are expecting is that Apple is set to announce a series of AI features in its new phones. And then I think one of the highlight will be Apple's announcement of its partnership with OpenAI. So I think users and analysts will be interested in seeing how Apple will allow third-party apps like ChatGPT to be featured on new iPhones. But at the same time, Apple itself is not trying to come up with such a chatbot application right now, but it is focused on offering AI-enabled features in its applications, including in Siri and then Photos and Notes to make users' life easier. But at the same time, if you want to use Apple's AI features, that means that you will need at least iPhone 15 Pro models or the new iPhones coming out later this year. So it is possible that with Apple's unveiling new AI features, it could help the company sort of bring a super replacement cycle this year and next year.
Yeah, Debbie, talk more about that replacement cycle because it, as you rolled out and told us about just now, this looks like it might go simply beyond software. Talk to us about the hardware implications of what could be announced this week.
Right. So for the new iPhones, it is we are not expecting any new announcement because that usually won't come until this autumn. But at the same time, the replacement cycle. So what Apple is doing here is that it will only allow users with newer iPhones to use its up-in AI features. And that means that if its features are attractive enough, users may be more willing to buy new iPhones and try out the latest features.
Debbie, thank you so much for laying that out for us. Lots to watch out for this week. Debbie Wu there for us. Right. And by the way, you can also turn to your Bloomberg for our clients for more on this. At TLI Vigo, we have a full blog post coming through as well as we move into this. Commentary, context, analysis, maybe some banter every now and then there from our expert editors here, of course. So catch that, of course, is the big one this week, at least on the micro.
Yeah, it was interesting what Mark Gurman wrote, too, about it's not just about the current lineup of hardware products that could benefit from these AI features, right? It could be a whole lineup of new gadgets that could come and play that could make this very, very exciting, right? Yeah. And I think the world has been waiting for AI to really or Apple to at least catch up with this.
The next big one from Apple outside of the...
Yeah, just the phone, right? You can talk about Vision Pro, AirPods, even robots they've been talking about as well.
I need to change my iPhone, by the way.
Me too. I'm sub 15, so yeah, I need some of those AI features. All right, take a look at when it comes to Singapore now. Several banks caught up in the country's biggest money laundering scandal are ramping up scrutiny of its rich clients. Let's get to our Bloomberg reporter, Avril Hong. She has more on this. So what do we know so far, Avril, about what the banks are doing to close these loopholes exploited by criminals?
Yeah, guys, I mean, this is one of the largest money laundering scandals ever hit the city-state. About 3 billion Sing dollars of assets have been involved. Basically, for context, just taking a few steps back before we talk about what the banks have been doing to close loopholes, is these syndicate participants have been able to kind of exploit loopholes, and they have been laundering the illegal proceeds from online gambling. So there have been a lot of questions raised since this case came to light last August as to how Singapore, as well as foreign banks operating in the city-state, have been able, or kind of facilitated in a way such action. And the key questions have been raised as to whether they're doing enough to screen some of their ultra-rich clients. So the latest we're hearing from some of these banks is like the likes of Citi as well as DBS. They're tightening up their checks. They're, giving more training for Citi. Some of the source and training materials that's been seen by Bloomberg, it shows that they're teaching their private bankers how to spot some of these tricks that criminals might be used to mask their background or the source of their wealth. And some of the red flags include if these ultra-rich clients or potential clients hail from Guangdong or Fujian provinces, which is where most of these men were from, and yet don't speak English and hold golden passports from countries such as Turkey or Vanuatu. So those are some of the red flags. We also have the likes of DBS. They're stepping up some of the vetting processes for major transactions. So that's what we're hearing so far from the banks.
Okay, now once this review that's being conducted as well, so once that's done from a regulatory standpoint, Avril, what then happens once we have a better understanding of the findings from that?
Yeah, so the Singapore regulator MAS has been going on site to these banks and conducting inspections. They've been interviewing the staffers, trying to find out what some of the weaknesses in compliance checks are. And it has completed those inspections, but once the review concludes, it's thought that the banks with the closest, the biggest dealings with this syndicate are going to face fines. Some of these financial institutions, about 16 of them involved, wasn't just about how they took on deposits. They also lent to the locally incorporated firms of these criminals. They financed property transactions. And for some of the biggest that had dealings with them, it includes the banks such as Citi as well as Credit Suisse. So we're watching to see what kind of financial penalties potentially will be imposed upon them.
And the criminal case so far, Avril, what do we know? What's the latest?
Right, so there have been 10 men that have been embroiled in this. They've all pleaded guilty. The last of them will be sentenced later today, and we have another 17 that are still under investigation, and they remain at large. But the sentencing later today, I think, in a way, kind of paves the way for the next steps in the case, because don't forget, there were billions in assets that were seized and questions being raised as to what happens to these. And it's become a bit trickier of late for the banks to kind of offload the properties amid the luxury property downturn in the country, guys.
Avril, thank you so much. Avril Hong there in Singapore for us. Plenty more ahead here on The China Show, so keep it here. You're watching Bloomberg. Welcome back. You're watching The China Show. It's extremely quiet out there. Beautiful, serene picture, though, out of Tokyo. This morning, a 1% to the upside. Well, make no doubt. And don't let this fool you into thinking that there is no big risk out of Japan this week. Of course, it's the BOJ. And what fireworks do you think they will engender in this market this week? Stay tuned for that. A preview, of course, coming up in a bit. But in a moment, though, let's talk more about Japan and the equity market implications of this whole, this whole value up, improving corporate governance. Almost 60% of Japanese companies are holding GM general meetings this week. That's 30% of them, in fact, happening all on the same day, June 27th. Investors are certainly concerned that this could limit shareholder engagement, just because everyone's in one place at one time, logistics issues. Hiroyuki Isono, our senior Asia stocks reporter, is here with us to talk us through. Let's start there. Why is everyone having their thing on the same day? Can't they just pick another day on the calendar, Hiroyuki?
Hi there. This has a very deep historical roots. If I could spend 1 minute on this. Basically, a long time ago, AGMs at the place where people sort of linked to gangsters harassed companies many years ago. This may sound a little bit ridiculous, but it was a very serious issue. I still remember one bank CEO committed suicide after a scandal involving his payment to these type of people was revealed. So basically, a lot of Japanese corporate executives were horrified by AGMs, and they have been trying to finish AGMs as short as possible. So it's almost like small fish moving herds to defend themselves from predators. Now, these things have become thing of the past, but they still tend to do on the same day. And partly that's because of the logistics. You got to hold these AGMs 3 months after the end of financial year, but some companies need to spend a lot of time to prepare for that. So those are the reasons.
Yeah, just do them all on the same day, so maybe you'll get away with something. It's interesting. What are investors expecting this time and this year's AGM season? And of course, we have the Toyota one that's coming up as well.
Yeah, this season maybe not be serene as the background behind here. And you mentioned Toyota, which is a great example. Toyota shares held by big banks is probably the most prominent example of Japanese cross-shareholdings. And basically, they decided to unwind this. So the process will start from, I don't know exactly, but sometime later this year. So this may not apply to AGMs, but this raises a very interesting point about the AGMs. Basically, companies like Toyota no longer can count on support from these cross-shareholders. And that means they need to pay more attention to shareholders' interests. Now, if we take Toyota's example, Akio Toyoda, who is the former president of the company, got 98% of support back in 2020, but his support has fallen below 90% in recent years. And for many Japanese CEOs, these vote matters. If you only get 70% of support, whereas your rival gets 90%, you really look very in trouble. And that puts a lot of pressure on Japanese CEOs to basically listen to investors more. And so the investors will be scrutinizing how much support CEOs will get in these AGMs. And some people even think that there may be 1 or 2 CEOs who might get voted out in the AGM. Of course, that's a little bit speculative at the point. But remember, last year, the president of Qian, which is a very long-standing firm in Japan, he almost got voted out because he only got 50% because of lack of board diversity. So the AGM season is only getting interesting from this year.
Yeah, looks to be like that the case. Thank you, Hiroyuki Isono, there, our senior Asia stock reporter, about this upcoming AGM season in Japan. Sticking to Japan now, its largest paper company, Oji Holdings, says it won't be stepping up baby diaper production any further in China due to the nation's shrinking fertility rate. Speaking exclusively to Bloomberg, the CEO, Hiroyuki Isono, says they're looking to expand in areas where they have recently acquired projects.
The market for baby diapers in Japan is becoming smaller and smaller because the population is decreasing. The fact that the market is getting smaller means that someone will have to exit the market sooner or later, considering profitability. On the other hand, we have an aging society, and the demand for diapers for adults has been increasing. In Japan, the demand for diapers for adults is expected to increase to a certain extent, and the market is shifting. The domestic market still accounts for about 60% of our total sales, but we have been strengthening our overseas business for about 10 years or so, and we would soon like to transfer more than half of our sales to overseas markets. Therefore, the Japanese market has become smaller in a sense, and we are thinking of expanding our business into areas that are growing more rapidly. We are in the process of implementing this plan.
How big is your exposure to China that's also suffering from an aging population when it comes to baby diapers, but also for the elderly?
As for China, we have one big factory, but in terms of overall exposure, it's not that big. I don't think it will even be 10% of our total exposure in terms of sales. Considering the various economic risks, we would like to maintain the current situation rather than increase investment in China. What we would like to do is to expand our business in Southeast Asia and Europe, where we have recently acquired some projects.
Because you're trying to work multinationally in different regions as well, how does a weaker yen affect your business strategy?
Although we would like to shift more business overseas, about 60% of our sales still come from Japan. The current low value of the yen is making the cost of importing raw materials extremely high. This is one of the major problems for our business. Another big factor is that when M&A is conducted overseas, the yen is not used. So the price is determined in the local currency, such as dollars or euros, which is inevitably more expensive than when the yen is stronger. This has had a significant impact on our business.
Is there a level of the yen that would be best for your business strategy going forward? And is there a base case for you thinking where the BOJ goes from here?
What will happen to the yen? It's hard to say, because it's also up to the Bank of Japan. But for our company, it was relatively good when the yen was very strong and was around 110 to the dollar. Even at around 130, the business environment would be good for us. I think the yen is a little too weak now.
There you go, Oji Holdings CEO Hiroyuki Isono with, of course, our Qian, who, by the way, deserves credit there. She's the only one who could probably sneak in a conversation and pivot that conversation from diapers to...
From babies to BOJ.
Babies to BOJ. from the micro to the macro, as they say. Interactive TV function. And if you can spot where Sherry snuck that in, missed that interview, of course, for our Bloomberg clients, you can find it at that function bottom of your screens. Be able to watch us live, but also, as we point out, catch all the previous interviews you may have missed. Check that out. You can also become part of the conversation. Check it out. TV Go. This is Bloomberg.
Here are some of the stories we're tracking for you today. Benny Gantz has resigned from Israel's emergency government, criticizing Prime Minister Benjamin Netanyahu's handling of the war against Hamas. Gantz has accused Netanyahu of hesitating over strategic decisions due to political considerations. He also warned the military campaign against Hamas will last years. South Korea's largest organization of doctors have voted in favor of holding a strike on June 18th. The Korean Medical Association says over 64,000 doctors, or close to 90 or more % of those who took part in the strike referendum, support the walkout. This is the first time it's taking collective action to protest against government plans to reform the medical sector.
Now, for a check across these markets, let's start things off with Japanese government bonds here. So you had that melt up in yields from Friday, obviously on the back of the jobs report, and that's really being felt across the region. So you have what's happening in Oz and, not in Oz, in New Zealand, for example. It's also, as you can see, playing out and might be setting up an interesting approach to the BOJ this week. So your 30-year yields are now up 6 basis points. The 10-year is now clear of 1.02 is where we're nearing there. And I guess the thinking may be here, if the Fed's not moving, then a BOJ might need to, if you think about it that way.
And as Mark Cranfield said from our MLive team, they have to do something about the yen. right? And there's also the speculation that they might start reducing their bond purchases, right? Maybe that's why you're seeing yields pick up as well, along with what we're seeing tracking these U.S. Treasury declines as well. But yes, the rest of the markets are doing this right now. It's pretty much slow going, but we're mostly lower when it comes to some equity markets here today. Obviously, there's the U.S. jobs report that we're dealing with. There's just so much we talk about this week and how jam-packed it is, and really, no one's really willing to put a whole lot of risk on the table here this morning. So you are seeing stocks mostly lower. Still watching those euro futures there, still on the weaker side as well, and the euro continuing to be quite vulnerable against most pairs. Coming up the next hour, we'll be speaking with Vanguard Group as China gears up to welcome a record high of close to 12 million graduates into its job market this year. More on, of course, youth unemployment in China. A lot on the way. You're watching The China Show. Welcome back to the second hour of the China Show. For those of you that are not watching, you're probably out there here right now. Beautiful day out there for the dragon boat races that are just kicked off here. That's happening in Hong Kong as well as in China. Of course, that's why markets are shut for the holiday here today. So hope you're getting your dragon boat in.
Yeah.
Hope you're getting some rice dumplings in, because we're certainly jealous. We're at work here today, Dave.
Yeah, well, if you're wondering where the traders are, some of them are competing.
Bloomberg's out there too.
Yeah, so we're not biased, but we hope we achieve something for once. I'm kidding. I think we have done quite well in terms of our team there at the Dragon Boat Festival. Anyway, markets are shut, so we're about 25% lighter than usual. Asia Pacific, though, we're still just below water. In fact, we should be much, much lower were it not for this bid up we're catching over in Japan. 0.5% to the upside here. A lot of central bank decisions, key ones this week, of course. Not that in any given week there is certainly a fairly important one, but this week, of course, it's the Fed. It's that dot plot. And what will it show? And I think Bloomberg Economics thinks we'll do one less. Yeah. As far as that's from 3 to 2.
Yeah, will the dot shift, right? 3 to 2, maybe, or if it's 1, who knows what the market's going to do?
Oh, no. The markets have 1.
Yeah, so maybe we're more in line with markets. We'll see, right? I mean, are they going to continue on this sort of hawkish commentary after, of course, that inflation print that comes before that as well, after that strong, of course, non-farm payrolls number that really shocked the market in some ways, especially when it comes to some of these bond traders out there as well. So it's not just, the Fed, we talk about Japan as well. That's the key one as well, whether we're going to see anything from the central bank to try to defend or at least support the currency here. Markets already, at least JGB yields already moving higher here this morning. And between that, they're sandwiched between Thailand and Taiwan too.
And we forgot to mention Thailand, which is has become interesting this year because of the leaning of the government leaning into the central bank to start easing rates for in less. Very blatantly, I guess in many cases you could actually say that. And
Taiwan hiked recently too.
Yes. Oh, there we go.
They're all interesting, actually.
Well, hopefully if there is a hike, it's not with the Fed this week. Now, market-wise, though, as we were pointing out, so yields are pushing higher. They would be pushing higher and expect them to push higher. In fact, when you get underway over in Europe later today, with really Bund futures coming under pressure in the early goings. Equity market futures, Euro Stocks 50, the contract, first row, 4th, 5th to the to the rightmost side of your screens there. We're down about 0.5%. Now, we don't normally see a move this pronounced, of course, in Europe at this point of the day. There is a lot to unpack, of course, as far as the politics there is concerned here. A 2-day look at the common currency. Just keep in mind, of course, we're coming off a strong dollar following the jobs report, so that's really leading to that big drop that you see on the left side of your screens. And weakness as we open here early Monday in the Asia Pacific, and the euro is not just weaker against the dollar, it's also weaker against just about every single one of its peers. And here's a look at some of the key ones on your screens on the back of this. Maybe for one, this far-right surge we got out of the elections, and perhaps also has to do with the fact that you are getting these elections unexpectedly coming through over in France. In fact, more on that story. Mark Cranfield is with us right now, our MLive strategist. Mark, what do you think is moving markets? Was it the breakdown of the vote, or was it what Macron said after the vote took place?
Oh, unquestionably the surprise decision to call an early French parliamentary election. So as you were saying earlier, I mean, traders would be going into this. This is a big event week anyway. And traders would have been looking into this week. You've got the US inflation report, you've got a Federal Reserve meeting, and you've got a Bank of Japan meeting. Any one of those could move markets, but traders probably would have some kind of strategy in place already. What they didn't have in place was any kind of thinking about whether France would call an early parliamentary election. That brings in a whole level of uncertainty that they just wouldn't be prepared for. And so markets need to respond to that. We probably will only get a really clear picture of how people feel about it when the European cash markets open later in the day. And of course, people will be looking very closely at the yield spread between France and German bonds, which has been very quiet for several months, understandably, because there's been no real reason for anybody to push that around. But now there is. You've got this decision here which will come as a shock to many investors, and they will probably respond defensively. So we could see a pretty ugly day for French bonds, for French equities. That could spill over into the euro currency. It's already a little bit weaker, but the real action will only happen once European markets open. And suddenly, instead of thinking that the Fed was the biggest risk this week, it might well be France.
Yeah, and we got a UK election coming up as well.
A few weeks.
It's interesting just the amount of election setbacks we've seen, and it's really roiled this whole carry trade right now, whether it's in Mexico and the like. You know, how are you looking at these carry trades here moving forward, Mark?
Well, the carry trades are most definitely at risk because of the situation in the United States, where the economy obviously is doing an awful lot better than people expected. So we had a jobs report on Friday. I think you said it was 4 standard deviations better than expected. Well, that obviously means that it makes it very difficult for the Federal Reserve to lower interest rates anytime soon. So you're talking about the dot plots. Any sensible central bank will want to give themselves as many options on the table as possible. So most likely they will only reduce the dot plots to 2 cuts instead of 3. They will be trying to avoid giving the markets a shock and creating unnecessary volatility. So it probably will be an incremental move, something like that. But clearly it's giving you the signal that rate cuts are further and further into the background. But the market may well look at it and say, well, even December is becoming a pretty challenging area for the Fed to start lowering interest rates, all of which supports the US dollar and doesn't help carry trades at all. Because as long as the US dollar is the powerful currency and it's yielding a decent amount, close to 5% in the short-term interest rates, really there's less incentive for people to go for these high yield but risky currencies outside. So really, the dot plots here may end up being another support for the US dollar and another reason why people start to avoid emerging market currencies.
And hence, Mark, what the strategy do you think should be ahead of the BOJ and possibilities on Friday, for example? Dollar yen's back at 157.
Well, I think from the Bank of Japan's point of view, if you read most of the reports, including on Bloomberg, they're expected to prepare the market for a small interest rate hike in July and probably to reduce bond purchases slightly. Well, that's pretty much known. That's a factor in the market. But the yen weakness really has been more persistent than they could have expected. They did a lot of intervention recently, by some accounts the biggest intervention they've ever done, and yet dollar yen is still not too far away from the highest levels that we saw earlier in the year. So really not very effective. It just shows you that the swing factor here for the markets for the yen is the Bank of Japan. So the best thing for them to do was surprise markets and bring forward the interest rate hike that is expected for July. If they do that on Friday, it will surely boost the yen. It might be a little bit disruptive for the equity market, but it can probably handle it. So really, a hawkish surprise from the BOJ is quite a big possibility this week.
Mark, thank you. Mark Granfield, the RMLI strategist, joining us out of Singapore. Coming up next, we're talking about more about China's job market as the country gears up to absorb over 11 million graduates into its workforce. We have Vanguard Group's Qian Wang joining us to look at, of course, overall labor trends, youth unemployment, the like. This is Bloomberg.
Welcome back. You're watching the China Show. So a record 13 or nearly 13.5 million people took the national college entrance exams known as Gaokao in China. That's on Friday and on Saturday. But the problem really of how to employ these students once, of course, they finish school. That's a big concern, of course, of the government, with Chinese President Xi Jinping making youth unemployment a top priority at a Politburo study session that I think was announced back in late May.
Yeah, I think we've went from, there was talk all year about 自苦, eating bitterness, right? You have to endure hardship. And then there was a little bit of change in stance just recently here. For more, let's get to our China correspondent, Min Lo. She's here with us in the studio. So set the context up for us. What's the youth unemployment situation looking like now? And why is this what they quote, the priority of priorities from the government?
Yeah, well, youth unemployment has hit record highs last year of over 20% in mid last year. Now it's come down quite a bit to just under 15% in April, but that's only after the government had changed the methodology for collecting the data. They had excluded students from the data set. And analysts that I've been speaking to say that this likely downplays the actual picture of unemployment because many of these students, they look for jobs quite early while they're still in school. So whether they can get a job really tells us a great deal about how the overall health of the labor market. So last year, I would say it's about the number of youths unemployed is about 2 to 3% of the labor force. Now it's just about 0.6%. So it's a small number, but the important thing is youths, they represent an outsized proportion of people who spend money in the economy because youths are the one going to the cinemas, to concerts. They are different from their parents' generation in that they tend to think less of the long-term financial goals. So if the government wants to get the economy going again and get people to spend again, they need to focus on the young people, make sure they have the income to spend and they are gainfully employed.
Yeah, and the skills mismatch, too, that they need to close, right? That was one of the things I think Chinese President Xi Jinping talked about. What measures have been talked about to address these concerns? And these are structural concerns, too.
Yeah, so previously they have come up with, I would say, rather piecemeal measures. There were tax incentives and subsidies to get governments to employ young graduates, but these amounts were ranging from 1,000 to 2,000 yuan. So they're quite low. It's like over $100 to $300+. That's not a huge amount to incentivize companies to hire, especially when the outlook for the economy is not great. So they need to kind of sort that out first. But it's a chicken and egg problem because how are you going to get people to spend when their income is not there, and how are you going to get people to hire when the economy is not good? And then they have to sort out the education mismatch problem. And that's something I think we want to look out for, whether there will be any reforms in the pipeline come July during the party plenum. They have been trying to improve or upgrade the vocational education system, but that's facing a lot of resistance from parents because there's still a lot of stigma about sending your kids to vocational school instead of colleges.
All right, Min, stick around. Our China correspondent, Min Lo, there. For more, let's bring in our next guest, Wang, Chief Asia-Pacific Economist at Vanguard Group, to have a deeper look into, of course, the unemployment situation in China. Wang, it's always great to have you. First of all, even after they changed the methodology, we're still talking about a youth unemployment rate at around 15%, which is still a couple times higher than the national headline figures. But I got to wonder, why is it so high in your eyes? Is it something that's more cyclical or actually structural?
Yeah. Thank you, Yvonne and David. Thank you for having me today. I think you're right. I mean, even after they changed the methodology, it's still much higher than the headline unemployment rate. Now, actually, that is pretty common. Youth unemployment is always higher than the aggregate unemployment rate, across many different countries because, young workers, they are usually don't really have the experience or skills. But I think in China, 15% is still high. And also, I think what is alarming is also that over the past several years, if you look at the old series, right, it was first reported in 2008, and it kept rising, right? So in 2008, that number started at 9.6%. And, before it was suspended last June, it was already over 20%. So there was a rising trend there. I think that is more concerning. Part of this is, I think, the weak economy over the past several years, right? We have trade war, we have pandemic, we have regulatory tightening, and even today, we see the economy is still a weak and gradual recovery, right? Normalization after the pandemic. Even by the end of this year, the output gap will still be negative. So this is really not a very strong economy. And a second thing I would also say, as we just mentioned, there is a structural mismatch between the labor supply and demand. The economy recovery so far is really, mostly on the low-end service industry benefiting migrant worker. On the other hand, the middle to high-end service industry that hires a lot of new graduates actually suffer from regulatory tightening or persistent, structural headwinds, right? So even manufacturing boom, over the past, several quarters, right? But we all know that manufacturing is much less labor intensive than service. And also, I think that the recent boom is actually on the high-end manufacturing, which is more technology incentive. So many of the college graduates, even they are willing to work in those, manufacturing sector, they don't have the skills,
Yeah, so talk to us then about, a lot of this also comes down to how we count and statistics, right? And, there could be, there could be people who are choosing to skip finding that first job and going straight into, say, going for the master's degree, otherwise they would have, done a few years and then did the master's. There would also be people, I would imagine, because they see what's happening in the labor market, just choosing to sit out and them now not being counted in the labor force. What is your estimate of the labor force right now? Is it shrinking or is it actually expanding?
Yeah, I think that's why I think we shouldn't just look at the unemployment rate. That's one indicator, right, to gauge the overall labor market conditions. One thing I think it was not captured by the unemployment rate is really the declining, labor force participation rate, right, especially among the younger generation, right? As you mentioned, I think a large part of that is because they are discouraged. They have weak confidence in this labor market, their job, prospect or, income growth. So they choose to stay home, and then they prepare for civil servant or graduate program exams. So, that actually has an impact on their income and overall consumption, as you just mentioned earlier. And also, I think another thing that may not be captured by the unemployment rate is that underemployment as well, right? So, based on the statistic methodology, as long as you work 1 hour in a week, then you are counted as employed, right? However, if you look at, headline news, you do see that self-employed individuals, they are getting less orders, or there's people are having less working hours. That's underemployment as well.
Yeah, I think it's very interesting because if you just go online and look at any recruitment platforms in China now, you'd find that so many jobs have requirements for master's degree when the role doesn't really justify it. I'm talking about roles like office receptionist, and it's because there's just this glut of people with master's degree now, and it's an employer's market right now. And so that's also my next question, because so many of these graduates, they're expecting to work in real estate, in banking, in tech. These are all the sectors that have been facing regulatory scrutiny and crackdowns and that aren't hiring as much as before. And the government knows that they need to reform the education system to ensure that the students come out with skills that fit the needs of the economy. But how do you think they're going to go about this?
Yeah. I think one thing you just mentioned about, master student, PhD student, right? China actually has been expanding the graduate program admission significantly in the past several years, especially during the pandemic, started in 2020. That kind of delayed the, undergraduate students' unemployment. However, it doesn't really solve the problem. They just kick the can down the road, and now they are coming to the market as well. So to that extent, it's not just the age group 19 to 24 unemployment rate is going to pick up in the graduate season. It's also the age group of 25 to 29 unemployment rate. I think in terms of the government, what they can do, right? I think to a certain extent they can encourage state sector, either the civil servant jobs or state-owned enterprises to hire college graduates, or they can expand the postgraduate program. This does not really solve the fundamental problem. The education reform you just mentioned, it takes years, to have an impact on the labor market. I think ultimately, I think at this moment, the most important thing is still about the economy, right? You literally need to boost up the economy and also the confidence, especially in the private sector, right? You know, private sector hires more than 80%, contributes to over 80% of the total employment, you know, especially those new graduates. So if the private sector business confidence is low, they are not willing to invest, they are not willing to hire, then of course, you know, then consumers won't have the confidence, and of course those college graduates either.
Yeah, so if I don't have a job, I'm not going to spend big, I'm not going to buy a house. That certainly is something that we're seeing here right now. I mean, what are these implications then if you know, the unemployment rate still remains high among the youth? What does this mean for the overall consumption recovery in China?
Right. I think it's not just the youth population, right? You know, they, you know, age 19 to 20, you know, 24, they are about 7% of total labor force. But if you look at, you know, the overall labor market conditions, one thing you would say is that, yes, the sentiment and confidence is still low. And in particular, I think one of, you know, the interesting shift, you know, change is that there is a shift in terms of the job growth and wage growth away from the middle to high-end segment of the labor market towards lower end, right? So that's mostly low-end service industry, that's like migrant workers. So, you know, if you put that together, I would say, you know, this is something that's going to make the consumption recovery more, you know, sluggish down the road. You know, like a lot of existing, you know, employees in many of the middle to high-end industries still worry about their job securities, worry about pay cut. How can they have confidence in terms of, you know, spending more? So I think this is where you're going to see yes, continued but very slow and weak recovery of the consumption, which is also featured by consumption downgrade. Yes, people want to spend, but they're going to spend more prudently, cautiously.
We'll have more with Qian Wang, head Asia Pacific economist, of course, there, chief Asia Pacific economist at Vanguard here. And by the way, for our Bloomberg clients who might have missed many of the sort of figures and statistics that we just showed you there, TV Go takes you back to our deep dive just now on the youth unemployment situation in China. This is Bloomberg. Welcome back. You're watching the China Show. Here are some stories that we're following at this point. An update here in Israel. So Benny Gantz has resigned from Israel's emergency government, criticizing Prime Minister Benjamin Netanyahu's handling of the war against Hamas. Now, he has accused Netanyahu of hesitating over strategic decisions due to political considerations. Now, he also warned the military campaign against Hamas will last for years. Now, South Korea's largest organization of doctors have voted in favor of holding a strike on June 18th. Now, the Korean Medical Association says over 64,000 doctors, that's about 90.6% of those who took part in the strike referendum, support the walkout. Now, this is the first time it's taking collective action to protest against government plans to reform the medical sector. So that's the strike. Given today's date, it's about 8 days from now. Just keep an eye on that, of course.
Yes, this has not been resolved for months now. You take a look when it comes to this market check, and yeah, we're talking about low volumes across the board here. Several major markets are shut, including here in Hong Kong, China, Taiwan, Australia here this morning. So really, the only equity market that's still seeing some decent green is maybe Japan, just given what we've been seeing with this weaker yen that's been back in play here. Kospi's down about 0.7%, and Nifty futures are still in the red this morning. And we're watching these, of all things, ice cream makers in Korea. So they're rising. Apparently, there's a heat wave going on.
Not on the strike.
In South Korea, no. It's just hot.
Yeah.
So that's why you're seeing this food and beverage index jumping here this morning.
Yeah. The Korean Food and Beverage Index up as much as 6%. KBS reporting that the summer this year will see higher temperatures than what we've seen in previous years. There we go. Plenty more ahead. This is Bloomberg.
1:29 a.m. in Tokyo here right now. Japanese markets heading to that lunch break. At least we're seeing a little bit of upside, I guess, when it comes to equities there. That weaker yen certainly is helping. There were some GDP figures that were also revised as well here this morning. But JGB yields continue to tick higher here. We're up in 4 basis points on your 10-year here. We're just days away, of course, from that Bank of Japan decision, Dave.
Yeah, more on that in a moment, too. The rest of the region doing this. Let's see, you have a lot of markets that are not up and running today. We're flat on price. We're slightly lower also in S&P. The dollar is still stronger, which is perhaps why we're seeing some pain across most, particularly the tech and the interest rate sensitive sectors that are trading right now, like the IT index, as you can see, is down about 0.5%. Going into a fairly, what should be on paper, busy and eventful week filled with risk events out there. But of course, the difference between risk and rich is 2 letters. So, of course, you do need to take one to maybe achieve the other. Okay, enough of that. Inflation is coming out of China this week, too. And certainly the conversations around the lack of demand in this economy might again be front and center. The forecast, the median forecast for May is 0.4%, coming off of 0.3%. Over a longer term view, as you can see, it's basically a low inflation environment. Is there an end in sight to this? Joining us still is Wang, Chief Asia Pacific Economist at Vanguard Group. Wang, thank you for staying by for us. So inflation is just one of the many metrics that we're latching onto for any clues whether the economy is responding to the current cocktail of policy stimulus. Where do you see inflation going, and is the sort of policy support enough so far?
Yeah, I think the inflation is actually gradually coming back. Last year we have the deflation. You know, I think headline CPI is coming back to the positive territory. I mean, you have 0.3, 0.4. That's a headline CPI. The core CPI actually is around 0.7, 0.8, slightly higher. And, you know, a large part of that is a gradual recovery, normalization of the service inflation, right? So, but still, I think you said it well. It's still a very low inflation environment, right? I think a large part of that is really because of the sluggish domestic demand, especially on the consumer side, and also significant build up in terms of the production capacity, right? So, you know, over the last several quarters, you do see that the key driver of the Chinese economy has been this manufacturing investment, industry production. And that kind of significant supply-demand imbalance is actually causing persistent deflation pressure on the goods side, not just on the domestic side, but also, you know, for the global inflation.
So, I mean, we mentioned about some of the policies, whether it's in the housing market, talking about inventory and trying to at least reduce that. I mean, do you think it's enough to talk about a turning point in the economy, or really is it just to limit the downside further?
Yeah, I think it's really just to protect the downside, you know, prevent a sudden collapse of the financial system or the economy. But on the other hand, I don't think it's going to bring much upside in terms of economy growth, nor is going to be a decisive turning point when I think, you know, everybody knows that the property sector is actually in a structural you know, downturn, right, for, you know, years to come. You know, I think it still take many, many years to clean the inventory in the Chinese, you know, real estate market at this moment. So I don't think it's going to generate, you know, a decisive, you know, upturn in the economy or the capital market.
The markets are now looking at the third plenum perhaps where we could get more catalyst for the market, not so much, I guess, for the economy, as you point out. Things are going to take some time here. What are your expectations ahead of the third plenum?
Well, I think, you know, to a certain extent, I mean, you know, the recent policy support that's ramping up, right, both in terms of fiscal policy, government bond issuance reaccelerated, and also a bunch of, you know, property, you know, stimulus measure. I do think that it actually reduced the policy complacency risk, right? So we are seeing the growth actually decelerate quite significantly in the second quarter after the initial surge in the first 2 months of this year. But I think given this ramping up of the policy support and also the strong industry production and actual growth, we think that growth is probably likely to stabilize somewhat around trend in the second half. So to that extent, I think 5% growth, that's a government target this year, is indeed achievable. However, I would say I'm really skeptical about the sustainability of growth down the road when you have the domestic household consumption still weak, property sector in a persistent downturn, and also I think the strong export growth is just unlikely to sustain, especially when the trade tension protectionism is rising.
Yeah, I mean, tell us a bit more about that, right? I mean, are exports quite vulnerable right now to those threats of rising, tensions and tariffs? And you don't think that's going to be enough in some ways to offset this domestic demand that continues to be weak?
Well, I think if you look at the last few quarters, right, it's interesting because when you look at just three industries, right, machinery, equipment, auto, as well as non-metal mineral, investment and production pick up significantly in those three industries, and the contribution from those three industries actually has completely offset the drag from the property sector, right? Now, I think that's why the China growth still remain kind of stable around, 5% at this moment. But then the question is it going to be sustainable? Because this kind of a situation is ultimately leading to, supply-demand imbalance, financial losses in the corporate sector. And then when China is trying to export its excess capacity to the rest of the world, the protectionism is rising, and also geopolitical risk is still there. I think U.S. actually imposed the tariff. Now, we could say that's only 18 billion, right? It's likely to have limited impact. But things could escalate from here, right? Europe is likely to join suit. And, just a few, this week we hear that Turkey is also imposing tariffs on China. EV export as well. So I think this is where I will be rather skeptical whether this kind of ever-rising export growth will be the key growth driver for such a big economy like China.
What's going well?
Sorry, what's going well?
Yeah, what's going well?
What's going on well in the economy? I think to a certain extent, I think you could say that the government is there to, as we mentioned, to protect the downside. So one thing I would say is that their primary objective, I think is, especially when they are, I don't think they have any intention to engineer a strong rebound in the economy because they are still worried about financial stability risk, right? So I think their main objective is to engineer a smooth deleveraging of the economy, right? Slowly deflating the property bubble. So on that front, I don't think we should worry too much about, say, a sudden collapse of the financial system of the economy. But I think, unless they really bring back the animal spirit of the private sector, they really stimulate the household consumption. Otherwise, I think, it is likely that the economy is just going to see continued deceleration in terms of economic growth in coming years, 5% to 4%, and by the end of the decade, probably coming to 3%.
Qian Wang, thanks so much for staying with us. Qian Wang, their Chief Asia Pacific Economist at Vanguard Group, joining us from San Francisco. Well, we talked about not just China, but really what's been going on in the U.S. economy as well. That surge in U.S. jobs and wage growth has traders pushing back their bets on the timing of the Fed rate cut, or the next one at least. Bloomberg opinion economist and University of Cambridge Queens College President Mohammed Al-Arian says the data takes a July rate cut basically off the table.
This is a really strong report on the demand side, not on the supply side, on the demand side, but strong in terms of demand for employees, strong in terms of wages paid, etc. It does close the door on a July rate cut. I think that is it, almost regardless of what the CPI number says next week. But then step back and ask the question of reconciliation with other data. And then the story gets a lot more interesting. We have this situation where the backward-looking data is strong, the forward-looking data is weak. So we've got to sort of reconcile these two things, which leaves us to the point that Lisa raised, which is what is your view of the economy? Because if you don't have that view, you're going to continue to get whipsawed for quite a few months, and you're going to miss windows of opportunity that are really important.
Does slamming the door on a July rate cut seem reasonable to you, or are you concerned that this is basically the wrong signal at a time where what comes next looks different than what came before?
Look, it's reasonable for a Fed that is overly data dependent. There's no way they can cut or signal a cut in July with this data. They would have to change their reaction function and be public about it, and I don't see the Fed doing this. So that's why the door is shut. Now, should it be shut is a much more interesting debate. You know my view. We are in a weakening economy. There are no spare tires to speak of anymore. There's no pandemic savings. There's no huge new fiscal impulse coming. There are no spare tires in this economy. So if you get it wrong and you weaken too quickly, it's going to be a very difficult mistake to correct. The problem is, which is the other bit of my view that you know, is we are living in a secularly inflationary world. Secularly, inflation is going to be higher because of all the transitions going on domestically. We no longer talk about liberalization, deregulation, fiscal prudence. We talk about trade restriction. We talk about industrial policy. We talk about fiscal irresponsibility. And globally, we talk about fragmentation. All that means a more inflationary world, which then raises the question as to what should be the right inflation target. So if you put all this together, it does shut the door for this Fed, but it will not shut the door on a very active debate that's going on that tries to look forward, not back.
Are you basically saying that the chance of a harder landing increases the longer the Fed does not cut rates, even if it appears strong on the surface?
I do, because I focus a lot on the forward-looking data, and that is weakening significantly. So yes, that's where I am. But I understand that if you're data dependent, there's no way you're going to come anywhere near my view, because you would have to completely change your paradigm.
And that was Bloomberg opinion columnist and University of Cambridge Queen's College president Mohammed Al-Arian there on his outlook post U.S. jobs and the Feds. That, of course, is also this week. That it's about Thursday morning Asia time. And in a few hours after that, I should just going to sneak this in, it's Game 3 of the NBA Finals, and maybe the Celtics are going for 3-0 at that point. Celtics just took Game 2 a few minutes ago. There we go. Plenty more ahead. This is Bloomberg.
Indian Prime Minister Narendra Modi has been sworn in for his third straight term, this after suffering a bruising electoral setback that forced him to share power for the first time. Now, Modi's swearing-in ceremony was held at the president's residence in New Delhi before some 8,000 guests, including business tycoons Mukesh Ambani and Gautam Adani, as well as leaders from Bangladesh, Sri Lanka, and the Maldives.
Yeah, now the recent market gyrations that we've seen, or we saw last week, in the country has investors debating whether or not to buy the dip, whether that premium is still warranted. Now, about an hour back, we were joined by Rahul, Chadha, who is the CIO and founder at Shikhara Investment Management. They're just starting this new fund, of course, a pure India play that gets underway in July. And we asked him really why he's bullish and why that strategy does make sense to him.
There are new consumer cohorts being developed. There are new industry segments being developed. A lot of multi-baggers have come. So clearly, for a bottom-up investor who's got a good regional perspective, being in Hong Kong, boots on the ground in Mumbai, and a good global perspective in New York, I strongly believe that we can generate alpha.
Now, investors bullish on Indian equities have cited the promise of policy reforms and the economic growth model under Modi to justify this very expensive group of stocks. But the so-called Modi premium is now under scrutiny following the recent election setback for the ruling party. Abhishek Vishnoy is with us, our senior reporter for Asia Equities, to talk us through this. And, well, the question there is why are markets, or what are markets making of these premiums going into Modi 3.0?
Well, if you take a look, markets have hit a new record actually. So that means net flow of institutional money or all kinds of money is actually pretty confident of what will be delivered under Modi 3.0. But the fact of the matter is it's a weaker than expected mandate for a prime minister under which India became the growth story that it is right now. So it obviously means some slowdown of that story. But, you know, it's like a car was getting driven at about 100 miles per hour. Now it is going to get driven at about 90 miles per hour. Nothing much changes apart from that. The playbook might change. There might be, some concern about possible slowdown in policy making, a possible focus on consumer as well, given the election mandate that government has gotten. And, budget, upcoming budget, which I think is in July, would be a key test of this thesis as to whether government changes its tack to tackle, the voters which were not happy and then go on in doing path-breaking reforms, whether it is able to manage this call for possible populism and pragmatic policy making. So budget would be a key test. All this essentially means that, equity risk premium rises a little bit, which means lower expected returns. But as the net flow of money has shown us, markets are trying to put this event behind us now.
Yeah, and does it in any way change overall how people's strategy around this market? Has the investment playbook for India changed in that context then?
Yeah, definitely. I mean, it has changed, and more so for foreign investors, who have been a bit cagey about India's story altogether. They have been selling India, weeks before election results came out. They called it right. The caution was right, but, markets have had a mind of its own. Markets are a new record, right? So they are not in the money. But, this just makes the investment playbook around India a bit defensive. Cross-asset guys that we've talked to are preferring bonds, ahead of that inclusion in the JP Morgan indexes, followed by inclusion in some other indexes as well. So that's a nice tactical play there. On the stock side, the investment playbook has become a bit tinge bit defensive. Values making a bit of a comeback. Sectors like consumer, sectors oriented towards consumer like mortgage finance, affordable housing, affordable insurance, so on and so forth. That is looking good to many investors. There is a test of whether, the India capex story and allied sectors like infrastructure, etc., would continue to do well. That is yet to be seen. Like I said, budget would be a key test. So tinge bit defensive on the India playbook, and cross-asset guys preferring bonds over stocks for now.
Abhishek, thank you. Abhishek Vishnoi there on the changing dynamics, of course, this Indian market post-election. And here are some other stories that we're tracking for you today. Speaking of elections and the like, German Chancellor Olaf Scholz's Social Democrats saw their worst ever result in the European Parliament elections on Sunday. Conservatives are on course to win some 30% of the vote and putting the SPD in third place behind the far-right Alternative for Germany. The outcome will establish which leaders will have the most leverage to claim the EU's top job. Italian Prime Minister Giorgia Meloni is set to solidify her power after winning the vote for the European Parliament. Her right-wing party is on course to gain over 27% of votes compared to the 6% in 2019. Meloni's projected victory comes amid a slew of positive results for right-wing parties in Europe, of course, as we talked about, in Germany as well, led by France. Of course, we'll leave you pictures outside of Hong Kong. It is a public holiday here today, and the boats are out. Not just the yachts we're talking about, the dragon boat races. And those races are going on here this morning. There's also a drone show tonight.
Yeah.
Plenty more ahead. This is Bloomberg.
I wonder whose yacht that is.
Can we join?
You got your Bloomberg on. Let us know. Feel free to slip into our DMs.
Ooh, look at them go. The races are on this morning here. I believe this is the average. I don't know where it is, but I think they're happening in several places there. I always want to be the drummer. I don't know if I have the arm strength to do this, Dave, but certainly they're on.
Those actually look like pros. Not to diminish, of course, the training
Man.
That many of our peers in the industry, of course, I think Bloomberg has a couple of boats competing today. That some of them, of course, in the background there, just catching the glue. I'm kidding. Some of the banks, of course, are also competing here, but these actually look like.
I love it. So festive.
Yeah. Okay. Good luck. Good luck to all of them. There. That does take, of course, a lot of orchestrated strength, if you will. Now, this brings to mind some of the reports in the tourism sector here in Hong Kong, right? So I was reading this. We were talking about this report this morning out of the Dim Sum Daily, and they're citing data from the immigration department here that when you have these long weekends and you hope for the F&B industry that people are staying and spending, they're actually going north again.
Half a million?
500,000 have made their way through the checkpoints into Shenzhen, and who knows beyond that, of course, this move north.
Yeah, this trend is not letting up anytime soon, right? I mean, just the amount of families that I talk to that go there for either, everything from playrooms that are bigger, cheaper, food that's cheaper, to even getting their dental work, right? I mean, that's something that you hear more and more.
That's not symbolism for anything.
Yeah, but it was interesting. Yeah, they're going to see the dentist there. There's also this whole trend of, mainland, they're talking about mainland visitors coming to Hong Kong. I think it was in around, 130,000? So not enough to really offset the amount of Hong Kong people that have really left this time around. And it just really begs the question of what the tourism industry is going to do in Hong Kong as a tourism board, right? They talk about all these mega events in the second half, right? Are these drone shows, these fireworks really going to cut it here?
There is a drone show today.
There is?
There is
8
one
p.m.
later today. That's not Star Wars. It's actually...
It's pretty cool, though.
It's pretty cool. Speaking of something that's on the way up, JGB yields, here we go. Up across the board, your 2, 5, 10, 20, 30, 40. We have a couple on your screens coming up as well on the back of this move up in yields we're seeing globally. This paring back, of course, of sovereign bonds. The BOJs this week, and as you can see, we're up by about 7 basis points on the long end, 2.32% now. The dollar's also on the way up, and this is dollar against EMFX, dollar China, dollar Malaysia offshore, and Korea and the Philippines, just to name a few. And these are fairly pronounced moves we're actually seeing in the dollar story, and of course the weakness coming through there in the euro on the back of what we found out on the weekend there.
Yep, so that's turbocharging the dollar in some ways as well on the back of that strong jobs report on Friday. So this is what your global macro movers are looking like. It's mostly red across the screen, across these asset classes here today. Stocks mostly lower, dollar firmer across Asia FX. Commodities are also on offer, and bonds continue to see yields picking up on this Monday morning ahead of a jam-packed week of macro event risk as well from the Fed, U.S. inflation, as well as that Bank of Japan meeting as well. That's it for us here in the China Show. Bloomberg Markets Asia is up next. Stay with us.